Welcome to the Deep Dive. We unpack the earnings calls that matter, giving you, well, the essential takeaways. Today, we're cutting through the noise of Edison International's Q2 2025 call. It just wrapped up after the NYSE close. And this wasn't just another call. Some really fascinating layers here, and we're going to help you understand what really moved the needle.
Absolutely. A critical one to dig into, especially with, everything happening on the regulatory and legislative front in California. That's always moving. We'll focus on the key financials, what management actually said about strategy, and importantly, what it all signifies for you if you're looking at the broader utility landscape.
Okay, so let's get right into those headline numbers then. What did Edison report for Q2?
All right. So revenue came in at $4.54 billion. That actually beat the consensus by about 2%, and it's up nearly 5% year over year.
Okay. Sounds pretty good so far.
Right. But the earnings picture, that was quite different. Both GAAP and Core EPS, they came in way below consensus. We're talking like 25% misses.
Oof. That's significant.
Yeah. And core gross margin also saw a dip year over year.
Yeah.
And cash flow, well, free cash flow for the year to date is negative $1.0 billion.
Wow.
Primarily driven by heavy capital spending, their CapEx. So even though management sounded pretty confident on the call, the market's reaction was, let's just say, muted.
Right. So on the surface, revenue looks strong, but that big EPS miss, negative free cash flow, that definitely raises a flag for me. A bit of a mixed bag, as you said. And the market was, well, unenthusiastic. So what's the real story here? Let's unpack this. What's driving these numbers? Okay, Let's really dig into that EPS miss. Revenue looks solid, so why were earnings so light? What's the underlying reason?
Well, the company pointed to a key accounting thing. It's SCE, Southern California Edison, their main subsidiary. They're still booking revenues based on the 2024 authorized levels.
Oh, okay.
They haven't gotten the final decision yet on their 2025 general rate case, the GRC.
The GRC, that's always a big one.
Yeah, exactly. And this lag means their operations and maintenance costs, their O&M, are up 23% year over year, actually. So those higher costs are sort of masking underlying growth because the revenue side isn't caught up yet. The good news, or what management stressed anyway, is they expect to record a true-up, basically an accounting adjustment to catch up the revenue once that GRC is finalized.
Okay, so they're accruing costs at 25 levels, but booking revenue at 24 levels for now. A true-up is coming. But here's the really interesting part for me. Despite these, current earnings pressures, management didn't just stand by their 2025 guidance, that $5.94 to $6.34 core EPS range. They reaffirmed it, and they kept their long-term growth target, that 5-7% CAGR through 2028. That seems like a pretty bold statement given this quarter's miss. What gives them that confidence? Should we believe it?
Well, their confidence seems to stem mostly from regulatory momentum, specifically the proposed decision in that 2025 GRC. It authorizes $9.8 billion in base revenue for 2025.
Okay, $9.8 billion. How does that compare to what they asked for?
That's 93% of what SCE requested, which in the context of California regulation is actually quite strong.
93%. Yeah, that sounds pretty supportive.
It really signals a pretty strong alignment between what the utility says it needs to invest and what the regulator seems willing to authorize. It takes some risk off the table for their long-term spending plans. This decision lines up with their rate-based forecast, supports critical investments, wildfire mitigation, grid upgrades, replacing old infrastructure, all essential stuff for California. The CEO sounded confident this framework backs the investments needed.
That's a crucial piece. It validates their spending plans, gives them regulatory stability. Does this 93% number maybe set a new tone for how regulators might approach future investments there? Seems significant. Oh, shifting gears. The big elephant, always for California utilities. Wildfire liability. What did they say about the Eaton Fire specifically and their overall strategy?
Right. So investigations into the Eaton Fire are still ongoing. Both SCE and the LA County Fire Department are looking into it. No new details on ignition or cost estimates were shared. But SCE did say they're not aware of evidence pointing elsewhere, and they believe their equipment could have been associated, though they stressed they think their conduct was reasonable for a utility.
Okay. Carefully worded.
Very. But the really interesting thing, they announced a proactive step, a wildfire recovery compensation program just for the Eaton Fire. It's launching this fall, aiming to give direct payments to people and businesses affected. The strategy seems to be resolve claims fast, cut down overall costs like interest and inflation effects, and make the most efficient use of the wildfire fund resources.
So getting ahead of potential litigation, maybe?
Seems like it. And the costs. They expect the first $1 billion to be covered by their own customer-funded self-insurance. After that, it taps into the main wildfire fund and regulatory assets under that key legislation, AB 1054.
That compensation program is definitely proactive. But is there a risk, you think, that they're setting a precedent? Or maybe even hinting at some fault before the investigations are done? How do you weigh that strategic move?
It's a calculated risk, for sure. They're clearly betting the benefit of quick resolution outweighs any potential perception issues down the line. On the broader legislative front, management sounded encouraged about talks with the governor's office and legislators. They're hoping to enhance that AB 1054 framework.
Strengthen the wildfire fund rules, basically.
Yeah, they think policymakers will push something through this session. That's a big positive signal if it happens. But it also brings up affordability, another hot topic. They talked up their cost management record, suggested alternatives to help affordability, like adjusting some of those public purpose programs funded by bills or making it easier to get permits for projects.
Okay, so they're offering solutions.
Right. But what really stood out was their strong warning against proposals to securitize capital.
Securitize capital. Can you break that down a bit? Why are they against it?
Sure. Securitizing capital essentially means bundling up future revenue streams or assets and selling them off as bonds to get cash now. It can seem like a quick fix. But Edison argued it would actually increase costs for customers in the long run. Their point is it would hurt the utilities credit rating, making borrowing more expensive, and those higher financing costs. They get passed straight to customers.
Okay, so short-term gain, long-term pain for ratepayers.
That's their argument. They even showed analysis suggesting, $1 less in earnings for them could mean more than $1 in extra cost for customers eventually. And they pushed back, saying their operational costs are competitive even with municipal utilities.
Makes sense. Okay, beyond the regulatory chess game and the financials, what about innovation? Anything new highlighted to keep the grid safer, more resilient? That's key for everyone in California.
Yeah, they specifically talked up their AWARE AI system. That stands for Advanced Waveform Anomaly Recognition Engine. It actually just won an Edison Award.
AWARE. What does it do?
It uses real-time sensor data from the grid, plus AI and machine learning, to proactively spot potential problems, like predicting issues or pinpointing failures before they cause big outages, or, crucially, potential fire ignitions.
Okay, proactive rather than reactive.
Exactly. The benefits they cited are better safety, reliability, faster restoration if something does happen, and even better affordability because crews aren't chasing ghosts, more optimized use of their time. And if you connect that to the bigger picture, their wildfire plan for 2026 to 28, they plan to invest a huge $6.2 billion.
$6.2 billion.
Wow. And a key part of that plan is shifting emphasis. They're prioritizing putting in covered conductor lines that's insulator wiring over doing more targeted undergrounding for about 1,800 miles of grid hardening. Plus, they'll keep using aerial firefighting assets. They also really hammered home their financial position, saying they can self-fund all this capital spending without needing to issue new stock until 2027. That's a pretty strong statement about their financial health and expected cash flow.
Okay, so a lot going on there.
Yeah.
But let's bring it back to the investor perspective. We saw that flat market reaction despite all this confident talk from management, the regulatory momentum. Why the disconnect? What does it all mean for you?
You nailed it. There's definitely a disconnect. Management's tone was, I'd say, guardedly bullish, really hitting those points on regulatory progress, reaffirmed guidance. Sell-side analysts seem to agree, calling the results maybe noisy, but directionally de-risking. They saw the path to that 6% plus EPS growth as still intact.
But the market just shrugged.
Pretty much. Muted response. It seems investors are really waiting for the actual legislative text on those AB 1054 improvements. They want to see the details, especially around strengthening the wildfire fund, before they're willing to re-rate the stock. And that's why the stock has lagged the utility sector ETF, the XLU, so much over the past year. Down over 36%, while the XLU is up 10%. It really highlights that California discount.
The California discount, that persistent valuation gap because of the wildfire overhang. It feels like the market has some PTSD from past events, right?
Absolutely. There's a show me, don't just tell me attitude.
So what could actually bridge that gap? What are the concrete catalysts that could shift this narrative for Edison?
Management actually laid out a pretty clear three-step catalyst map. First, a legislative fix for AB 1054 this session. That's number one, strengthen the framework. Second, a favorable vote on that general rate case from the CTUC. Earliest that could happen is August 28th. That locks in the 2025 revenue. And third, issuing those $1.6 billion in securitized bonds related to prior wildfire costs. That's important because it cleans up the balance sheet, frees up capacity.
Okay, legislation, GRC decision, and the bond issuance.
Exactly. They believe those three things, plus delivering that consistent 5-7% EPS growth, growing the rate base, and offering that, frankly, attractive 6% dividend yield. That combination could genuinely change the story. The goal is to shift perception from wildfire risk headache to regulated clean energy compounder. And they pointed to other regulatory wins too, like getting approval to recover over $1 billion in past wildfire costs and progress on that securitization application. Lots of pieces moving, but seemingly in the right direction.
All right. Now, as always, this next bit is purely for entertainment illustrative purposes. Definitely not financial advice. But if you were pitching an outrageous, maybe, but still plausible trade idea based on this call to an investment committee, what would that look like?
Okay. Outrageous but plausible trade idea. Given the market skepticism we just talked about, but also that very clear catalyst map they laid out, I'd pitch a long-dated, out-of-the-money call option strategy on Edison International.
Okay, call options. Why?
Here's the thinking. The core earnings stability seems to be there, underneath the noise. Management's confident, reaffirming guidance, talking long-term growth, and the regulatory picture, well, it really does seem to be tilting in their favor, as they put it, with the GRC and the AB 1054 talks. The stock is cheap relative to peers because of that California discount. The outrageous part is betting against the market's current stance, which demands that legislative text first.
So you're betting the catalysts play out before the market fully prices them in?
Essentially, yes. The pitch would be, by call options expiring maybe Q1 2026. This gives us time. We're targeting a re-rating of the stock maybe back towards historical multiples, or at least closer to the XLU, as those three catalysts hopefully hit over the next 3-6 months. The options give you leverage to capture that potential upside if regulatory clarity comes through, but without tying up huge amounts of capital in the stock itself if, say, the legislative process drags on longer than expected. We're basically betting policymakers will do the right thing, as the company hinted, and that the market will eventually have to acknowledge the value being created once the regulatory environment is clearer. If that three-step map works, the payoff on those calls could be pretty significant.
Interesting. A leveraged bet on regulatory execution.
Exactly. High risk, potentially high reward based on those specific catalysts unfolding.
Okay, so there you have it, our deep dive into Edison International's Q2 2025 earnings call. A company sounding confident about its path, despite that headline EPS miss, pushing ahead on big investments and wildfire safety tech.
Yeah, the key takeaway for you really is this ongoing dance between the legislative moves, the regulatory outcomes, and how the market feels about it all. The share price reaction was flat now, but the potential for a re-rating is definitely there. It just hinges completely on executing those regulatory and legislative tailwinds. The story could shift from wildfire risk to clean energy compounder, but investors are clearly waiting for proof, waiting for the ink to dry on that legislation and the GRC.
We've given you a lot to chew on today. And remember, this is all just for informational purposes. It is absolutely not financial advice. Thanks for joining us for this deep dive. Keep those questions coming for our next exploration.